Welcome everybody. Hope you're all staying warm. It's quite a kind of a bitter day out. Hopefully we've got a little upward movement in the grain markets today, so that should take a little bit of the edge off. I'm going to be talking about the soybean outlook. Here's my contact information. So if there is something that comes up later that you think about or you want to have a visit, I'd be happy to do that and try and answer whatever questions you have. All right, so first slide, I just want to set some context here. I'm not going to go through these numbers in gory detail. I'm just trying to use these as kind of the framework. This is the most recent information we got from USDA in both the supply as well as the demand for soybeans. So the supply part is the top half of the table. The demand piece is the bottom half of the table. I'm going to be looking and talking a little bit about those ending stocks numbers. How much do we have left over from marketing year to marketing year? Up until this point, I guess, up until basically harvest, we spend a lot of time arguing and debating about the size of the crop, again, planted acres, what are yield potential. Obviously, we had some very dry conditions in the Western Corn Belt, in the Western growing regions, including North Dakota, South Dakota, and Nebraska. But yet we also had some pretty excellent growing conditions as you get into the Eastern Corn Belt. So when everything is all said and done, and we'll get the final official yield numbers and planted and harvested acreage in middle January, our production numbers were kind of right on average, kind of where we expected them to be. So right now, as we move into the winter months, obviously things have shifted a bit. What is the market focusing on right now? It's really two key things. I'm going to make this as simple as possible. The first key thing is how quickly are we using up our stocks or reserves, primarily through not only export sales, but also through crushing demand. And then what is the potential size of that South American crop? So those are the really big news pieces, although there's some other things that are also, I guess, influencing the market that I want to talk about very briefly. So first, to put things in historical perspective for everybody, the blue line on top is the amount of soybeans, whole soybeans, that go into the crushing sector. We crush into the oil and meal. The meal goes into livestock feed primarily. Some goes into export. The oil primarily goes into food products. Again, a wide range of food products. I'm going to talk about some of the changes occurring now in the near future as well. And then the red line is exports. The dotted lines on the far right-hand side are the current USDA forecasts for the 12-month marketing year. So those would be 12-month totals that we're looking at. And the two things I want you to be thinking about and observing is, what are the general trends? So let's talk crushing first. The general trend in consumption, or the amount of soybeans going into the crushing sector over the last about 10, almost 15 years now, has been a general climb, a general increase. Again, a lot of that has been driven by the meal complex, soybean meal. But now more recently, a lot of the new plants that we're seeing entering into the marketplace, in particular, for example, the one at ADM plant in Spiritwood, the plant that's being constructed now, or starting construction in Castleton, and the one that was announced in Grand Forks, that was actually moved from Crookston into the Grand Forks region. Those three plants in our region, yes, they're going to be crushing. Several of them are also going to be refining the oil to be used for a wide range of products. But a lot of the driving force behind this increase in more recent increase in demand for crushing is really been driven by renewable diesel. Okay, and renewable diesel is different from biodiesel. Biodiesel, you're taking vegetable oil like a soybean oil. It's been refined to a very high level. You're blending it with diesel fuel as a fuel additive. Renewable diesel is a little bit different. We're taking the same soybean oil, refining it to a very high level of purity, but we're actually running it through a oil refining system that's been, again, modified slightly, and making diesel fuel. So in the renewable diesel sense, we're literally taking vegetable oil or another lipid, running it through a refinery and making diesel fuel. The advantage to that is the diesel fuel made from soybean oil or other vegetable oils is essentially identical to the diesel fuel that's made from crude oil. The difference is the greenhouse gas emissions, or the amount of carbon that's released from renewable diesel is about 70%. Some would say closer to 80, but about 70% of the carbon released, lower of the carbon released from, let's say, a crude oil process. So there's a major reduction in the carbon released, which has some really interesting properties and has some really interesting market opportunities, in particular into that the diesel market in California, as well as some of the aviation fuel. So there's also some very large airlines and manufacturers, aircraft manufacturers, looking at renewable aviation fuel as well. So this isn't going to happen really quick. It's not going to impact really the markets in the next 6 to 12 months. But as we look forward in the next, say, 18 to 24 months, this will start to have an impact primarily on local demand. So it's something that is a developing story, and we'll continue to talk about as we move forward. Now, shifting back to short term, there is the crush demand we're seeing out of the United States right now still remains very, very strong. There have been plants that have been expanded, that have existing plants expanding. There are obviously, as I said, new plants coming online in the near future. The other piece, I'm going to talk about these separately now, would be also the export portion of it. And USDA is forecasting a slight reduction in exports based on the previous 2 years. But recognize 2 years ago, that was a record high soybean export. So to come off of that record high levels is probably legitimate. Most of that was driven by the U.S.-China trade war being at least mitigated, at least resolved to some degree. And then now this year, there's the expectation for a very large Brazilian soybean crop. So again, the expectation is we're going to have a lot of competition coming up very shortly. So I'm going to talk about those two separately. Just to give you an idea of the potential, the growth potential that we're talking about from this renewable diesel phenomena, there's currently 14 plants across the United States. Actually, some would say more than that. But the 14 plants that have been identified, either under construction, under expansion, or under development. Now, under expansion, obviously, those are facilities that are already operating. They're just expanding their capacity. Under construction would be similar to the ADM plant in Spiritwood, where they're actually constructing it. They're pouring concrete. They're making the revisions. They're making the changes to be able to have a new plant online shortly. The under the development part is a little bit shakier because it's very easy to have a press release saying we're going to do this. It's a whole nother thing to spend about $400 million to put up a new facility. So some of these facilities, depending upon the profitability in the next probably year to year and a half, may or may not get developed. But just hypothetically, if these 14 plants that are currently being planned come to fruition, where they actually become operational, that would add about 450 million bushels of crush capacity nationwide, which equates to about 20% increase in the crush demand. So this movement into the biofuels area, the expansion of renewable diesel, has this growth potential that a lot of people are getting very excited about. Now, shorter term, when we look at exports, I will just want to explain this table very quickly. Think about it in kind of two pieces. The left-hand piece right here is our total exports for the full marketing year. And what I've tried to do is break it down by country to give you an idea of where do we sell most of our soybeans and what about this export pace we've seen so far this year. So the far left-hand 4 columns are going to be for 12-month totals, just to give you some historical perspective. The far right-hand, these last 2 columns, represent the amount of export sales, those contracts we have in place for soybeans this marketing year. So the marketing year starts on September 1. So this would be from September 1 through the most recent information we have available, which is kind of the beginning of December here. So on the far right-hand side, this is the information for the current marketing year. These are the sales that we have on the books right now as of the most recent report that we got last Thursday. And then the next column next to it is the amount of export sales we had for this time last year. So let's compare last year's pace to this year's pace and break it down a little bit by country. So first, if we look at where we are right now relative to this time last year as a total, we're actually ahead, and ahead by a ways. But a lot of those sales were actually being made from China or unknown destinations, which often get attributed to China, over about the last 2 weeks. So up until about 2 weeks ago, we had kind of a slower market pace. We had a slower export pace, but that's become more aggressive now in the last several weeks. So we're sitting right now, China is ahead of where they were this time last year. Mexico, being our number 2 customer, is also ahead, but not dramatically ahead of last year. And then we have some of these smaller countries, smaller from an export standpoint, that do bounce around. Again, we do have quite a bit of the export season left. So some of these countries may come in and increase their export purchases over the next several weeks. So just to give you a reference point, where are we sitting right now? If you were to see these numbers, you say, well, maybe we'll have a better export season than we had last year. But again, there's some things that might mitigate that or might cause that to shift as we go into actually after the first of the year here. One of those is, of course, what's going on in South America. I just wanted to give some reference points for how large the production of soybeans is in these 3 major producing countries. Now, the blue line is kind of the number 1 producer of soybeans, which is Brazil. The green line is the United States, and the black line is Argentina. And again, once again, the dotted lines on the far right-hand side represent the current USDA forecasts coming out of these 3 different countries. Now, because of some weather conditions, some of these forecasts, in particular for Brazil and Argentina, are being trimmed just a little bit, but they still fall well within kind of the range that USDA is forecasting. So the point I'm trying to make is both Brazil and Argentina, when we look at bushels produced or tons produced, Brazil is expected to have a very large increase from last year. In fact, if we look at what's currently being projected versus their record high, which is actually in 2020, it's about an 8% increase from their previous record. So right now, the expectation is we're going to get this really monster crop, soybean crop, coming out of Brazil. Some of that is because we're shifting acres around, not necessarily adding a lot of new acres, although there is some new breakings going on. A lot of it is the shifting of acres internally. A shift away from some of the corn acres, from some of the cotton acres, from some of the sugarcane acres, and into soybeans. In Argentina, again, the assumption for the Argentina number is that we are going to have a trend line yield. And based on some of the weather forecasts, as well as current weather conditions, there's some real concerns starting to appear that may not be achievable. And I'll talk about that in just a moment. Now, shifting from production to exports, who do we compete with on the export market? Just because you produce it doesn't mean you have to export it. Brazil does have a relatively large internal crushing sector that we have to be concerned about. So when we look at exports, now this would be exports of whole soybeans. These are not soy products. So if you look at the black line on the bottom, which is Argentina, you notice that they don't export a lot of whole soy. Most of the exports that Argentina have are soy products, the soy meal and the soy oil. So it's processed first, and some of that's because of their internal taxation system. The tax rates for exporting, because they have export tax to raise revenue, the export tax rate for whole soy is higher than it would be for the soy products. So they're trying to, again, to try and not only generate revenue, but also encourage domestic crushing. So when we look at whole soybean exports, the real 2 big exporting countries are Brazil and the United States. And as you can see, back in about 2014-15, Brazil surpassed us as being the largest export of soybeans in the world. And they're actually much larger than we are here in the United States. So we're looking at a recovery or an expansion of potential for soybean exports out of Brazil, as well as a small increase out of Argentina. So let's graph that on top of what is the demand base. And with China being the largest buyer of soybeans from the global market, from both the U.S. and Brazil. And I want to point out, for about the last almost 20 years, we've really relied, or the globe has relied on this increasing demand base, this increasing demand for soy and soy products from China to support this expansion of acreage as well as expansion of total production. Now, that started flattening out way back in actually 2016, 2017, before the trade war actually became a really big thing. So there's some questions saying, well, what is this expansion or this growth rate coming out of China for the next several years? Now that big V, this drop that you see back here in 2018, that's a combination of African swine fever that really dramatically cut the hog herd in China, as well as the trade war with the US. So the combination of those two, global imports by the Chinese dropped pretty significantly. After the trade war was resolved, at least temporarily resolved, they did start to rebuild the hog herd, and we saw an increase in importation. Some of that was to rebuild some of their inventories, and some of it was because the demand base was increasing. They had a drop off last year, primarily because of COVID, and the forecast right now is for an increase or return to exports. My point I'm trying to make here is that the demand base, that the need for more soybeans from China seems to be flattening out and has been flattening out for the last several years. So we take this demand base that's flattening and combine it with increased competition from Brazil, and all of a sudden there's this potential for a lot of price competition going on in the global market, in particular for US soybean exports. So that's something we need to be watching and thinking about from a marketing perspective over the next several months. Turning back to kind of what's happening internally in the United States, one of the things that not only I, but a lot of marketing people watch very closely is what is our stocks to use ratio, or the scaling on the far right-hand side. Those are the blue bars we see in this graphic. So those blue bars represent how much inventory do we have just before harvest divided by our total use. So if we think about it as what percentage of our total needs are we going to have in reserve in case there's a problem just before harvest, this gives us a general indication. And the red bar on the far right-hand side is the current USDA forecast, assuming that their projections for the next 12-month marketing year are correct. We would expect to have just under 5% carryover stocks available just before harvest of next year. So our translation is our margin for error is pretty thin. And one of the things that we start to see when that margin for error is pretty small, when those blue bars are relatively small, we tend to have two things happen in the marketplace. Number one, we tend to have higher average prices because our supplies are tighter, and we tend to see a lot more price volatility. So prices change a lot more quickly because that margin for error is so small. Any new piece of news, whether it be that we have better supplies or the demand has dropped, it's like, okay, well, prices will start to fall and fall fairly quickly because our margin for error is been relieved. We don't have to be as aggressive in rationing our consumption. On the flip side, if the demand looks stronger than we expected or the supply smaller than we expected, we start to see very rapid price increases. So I want to point out a couple time frames here just for comparison. Notice what we happened here in 2012, 2013, 2014 time frame when we had very, very tight supplies. And then coming back here into the trade war years when we had these very large supplies that started building up because of the trade war. So let's compare over time and historically. This goes back to 1990. This is what's called a continuation chart. So this would be the futures market prices for nearby deliveries. So this would be the futures market that the local elevator is using to price soybeans for delivery today or at that time period. Okay, and this goes back, now this has not been adjusted for inflation, so just absolute prices. Okay, but I do want to point out what I'm starting to talk about is that if you look at what's happened here in this 2012, 2013, 14 period versus what happened back here in the 2018 and 19 time frame and where we are today, you see this relationship. As the stocks get very small, we tend to have high prices, but a lot of price volatility, which makes marketing the crop exceptionally difficult because obviously everybody wants to have the highest price, but trying to achieve that highest price is going to be very, very difficult, very tricky. So I took this graphic, or I took this picture, if you will, I captured this as of about 9 o'clock this morning. And so this blue box at 1484 is the futures price in January for the January contract, which would be, again, used for today's delivery, at about 9 o'clock this morning. So let's just look at the current price we're seeing relative to where we have been historically. A lot of times you look at the spike that we saw this last summer and saying, oh man, I want that $17 back again. Well, that ain't going to happen, guys. We have a pretty large crop right now. We're expecting a much larger crop coming out of South America. So we have to kind of hit this reset button on what our expectations are for a good price. And I just want to put this in historical context, saying at 1484, if we look back historically, there's very few times that we've been able to achieve these kinds of levels, price levels. So if you look more shorter term, this would be for old crop soybeans. Again, we're looking at 2023, the January contract. This would be the futures price that the current elevators are using to price today's soybeans. The black box now, the colors have changed. The black box is that 1483, 1484. This is where we were at about 9 o'clock this morning. So let's look at this price relative to where we have been for this January time period. And notice we've had kind of a recovery now in prices over the last several months after harvest has begun because of some uncertainty, primarily some weather uncertainty coming up in Brazil and Argentina, primarily Argentina, I'll point out, as well as this relatively strong export pace that we've had so far in this growing season. Okay, so the question is, how high will they go? I've drawn in these different colored lines. This 15, call it 1510, that was the spike that we saw back here just before harvest began. Okay, now I would use that as one of those absolute high pricing points. It's very unlikely that we're going to get soybean prices to break through that level unless something very unusual happened, in particular in South America. So my concern is we have to put some realistic expectations on pricing and price movements. At what point would you be willing to sell some additional soybeans, in particular for old crop? What I'm going to comment on here is that I am concerned because the Brazilians started planting their soybeans early. They had a relatively dry spring. They started planting early. Planting progress was very rapid. Their harvest is also going to be earlier than normal. And so I do think we do have a window of opportunity here for the next several weeks, probably into kind of mid to late January, where the United States will be the place that the world comes to for soybean purchases and soybean deliveries. But once that crop starts to be harvested in Brazil, especially northern Brazil, again, likely a little earlier than normal. So I'm expecting something to hear some reports of harvest beginning again mid to late January this year. Once those soybeans start to flow to export, then all of a sudden our export pace will likely drop off as those buyers begin to move into the Brazilian market and sourcing their soybeans from Brazil. So in my opinion, as we move forward, we've got a relatively short time period to try and price some old crop soybeans to finish up those sales. Now, if you want to hold soybeans beyond that point, you go into February, March, or April, what you're really gambling on is that there's going to be a major problem, a major production issue coming out of South America. But I want to point back and remind you of what we saw earlier, where the Brazilians are going to have an expectation for this massive, massive production. Even if they do have some yield losses, it's very unlikely that they're going to have large enough losses to really make a huge difference or to get their supplies down to the levels that we saw even last year. So just to keep that in mind. As we move into, I got to watching my time here. As we move into new crop soybeans, I do think there's going to be some opportunities, but take advantage of those opportunities. I would be starting to market some of those 2023 soybeans for November delivery. Notice that we have this pretty strong psychological barrier at about 1405. We've been bouncing and touching that level. I'd be starting to sell some. Don't be too aggressive because there's things can still happen, but just be watching those as we move forward in time. So I do think there's going to be some pricing opportunities, especially now after the first of the year. We're kind of in the holiday doldrums right now, so trading volumes are relatively low.